Hi, everyone. Welcome to the weekly webinar. I just wanted to do a quick update for you. You're going to love this. We've got a lot of new information on here. Let me know, as I always ask you to do, where you are, and happy Easter to you all, where you are, and if it's your first webinar. You can keep the questions coming whilst I speak, because I will indeed, during the course of this, answer them all, and I'll stay until as long as it takes. So let's kick off straight away with the first slide. Now, I showed this last time. The reason I'm showing this is because this is where my 100% returns are going to come over the next 2 to 3 years. Now, if it takes 5 years, then, and it's not going to be all of these stocks, I've got to decide which ones, though, and it's not right now. I'm not getting into any of these right now, but it's going to come from these. If it takes 5 years, it would only be 15% per annum returns. If it takes 2 years, it'd be 40% per annum. But it's going to come from some of these. I haven't decided which it'll be yet. I'll show you how I decide in a moment, and we'll have a look at it in a moment as well. Okay, so one of the things I want to show you is, for instance, it will almost certainly be, for instance, this. I'm not in this at the moment, as you know, because it's what I call a daddy bear. I've got into cash, but I'll explain exactly what that means. And it's really this pattern here. Okay, when that sort of thing happens, I really don't want to be in. And this is an update on that. But I also know that when we do get in on the rise, we inevitably get very good returns, especially if we had a bit of leverage into all of that as well. Hello, Sean from the Midlands, Jeff, my friend from Malaga, Martin as well. Rod, hello, everyone, especially if you are regular. So we've got Matt, Andy, Neil, Bruce, Ian, Roy, Paul, another Bruce, another Andy, Jake, Martin, Rajesh, Rod, Svent, Christian, and so on. Now, let me explain. When I look at something like this, one of the simplest ways to look at this is not geoeconomics or geopolitics and macroeconomics. As Warren Buffett famously said, he's never picked a stock based on macroeconomics or breathless headlines. His words, not mine. Okay, one of the easiest ways to ever get a good, quick interpretation for me is to look at where people are putting their mouths, i.e., where are they putting their money? If they put their money where their mouths are, which is what prices show me, and I see average prices short and medium term declining, then I know generally, as a rule, not as a guarantee, I probably want to be out. And if I see short and medium term prices generally rising, then I know as a general rule I want to be in. I want the company to be fundamentally sound as well. And I'm going to show you what I mean by that in a second. And this is why I'm out of Amazon at the moment, but I know I'll be getting in again at a cheaper, lower price. Now, Warren Buffett doesn't get 100% out, or rarely he does, out of companies he likes. Because he'd probably crash the market if he did. So that's why he still holds lots of Apple. What he tends to do is, as the price falls, he does the second part of what I do, which is get in at a lower, cheaper price. How do you decide that? Well, I look at average prices. Why do I look at short and medium term average prices? Well, across my 18 odd books and all my FT columns, consistently, it has been better than trying to interpret economics and politics. And I have a master's degree in politics and economics. And I can tell you, it doesn't help you with trying to forecast the stock market, not least because psychology gets in the way, which I don't have a degree in, and biases, and do I like Trump or not, and so on. That's what the public like to do. It's what media will feed into you through breathless headlines. Again, Warren Buffett's words, breathless headlines, not mine. Joseph from New York, hello, my friend, as well. Peter, Auckland, peaceful Easter to you and everyone as well. Loughborough, Vijay, thank you very much. So given that that gives me a quick update on where I think things are by just interpreting the average prices and their direction of travel. Now, a lot of people go, oh, no, what you need to be doing, Alpesh, is reading Donald Trump's mind through a crystal ball and through a psychiatrist. And I think now's a good time to explain to people why, whilst notions of politics and economics, and I do a lot on the BBC and on Bloomberg TV, I had my own show, and I can tell you, politics and economics interpretation can give you just as much reasons to do one thing or another. Where people are putting their money is a greater indicator of the truth of what they truly believe, okay, and the people who matter, right? So a talking head journalist can say all they want They don't matter because they don't have any money because they're journalists. The people who've got the money, whatever they believe, whether or not they believe the truth or not. So Trump's figures on tariffs, whether they're true or not, doesn't matter. What matters are the people with the money, which direction they're putting it in. Okay. Now, if you take some of the biggest hedge funds in the world, like Winton Capital, AHL, Aspect, you would find that JW Henry, you would find that they tend to look at momentum. So anyway, that's part of what I'm going to say. Now, people find that hard to accept, but actually, what I'm saying is, in the short term, nothing more than what Warren Buffett says. In the short term, the stock market is a voting machine. In other words, as he says himself, it is all about votes. In other words, momentum and where is the public going. In the longer term, it is a weighing machine, i.e., what do the fundamentals look like? Okay, all I'm doing is when the votes are negative, I'm just stepping out aside, as he does, as he has from Apple a little bit. And as he does, when it's a weighing machine and the market realizes it's overdone and starts going up, I buy in again, as he does. All right, nothing different, nothing different. Now, let me explain to you, whilst we can look at all of these things and say, well, Amazon, is it good or bad, etc., etc. I know, and Joseph, you know this as well, and we'll discuss this in due course when the time's right to be getting in around there. Let me see if I can move some of that ink, by the way. Erase all ink. They should make it easier. They probably do. There's probably a button down here somewhere where you can do that. When the time is right to be getting in around here, we know we'll do some leverage even on it because we'll have, for our risk appetite, the confidence to do it. But not now. I don't want to ride that down. But I want to show you something else and why so many people find it difficult. By the way, this is discount cash flow and suggests Amazon is 46% undervalued. I'm still not getting in right now. I could, but I don't want to because I think I can pick it up cheaper. Call me a cheapskate, but I think I can. Oroville, California, welcome. David Newton, Lewillows as well. Now, this is a statistical depiction of typically the range of price moves Amazon can make. Now, I'll tell you why this is, I won't say there's a holy grail, but why it's so incredibly important for us to know and be aware of. Okay, and this is where people get messed up. And this is why, there's a time to teach people certain things. I could teach you this at other times of the year and you just will pay no attention. But in the context of Trump, you'll see what I'm saying more clearly. When you get extreme volatility and a drop of, say, 20% in 20 days, you can imagine people panic. Journalists love it. When we used to do our Bloomberg TV show, we loved it because it's interesting. Okay, remember, we've got to fill the air 24 hours a day. We love it when there's volatility because we've got something to talk about. We can be breathless and excited. And we'll know we get more advertising because we get more eyeballs. Simple as that, right? So over 20 days, you get these extreme volatile moves. If you get that in 5 days and something drops 14%, of which there's a very small probability, but if that happens, you're going to panic. Don't tell me you're not, because you're human. If you get a 9% drop in a day, the only two people who aren't going to panic is me and Warren Buffett. We've seen it all before, and he's my age. All right, 95. All right, 5 days, you're going to do that. You're going to do this. Very few people, myself and Warren Buffett are the only two on the planet who can do this, would stay calm. Okay. In fact, when we see something like this, and if we can get stocks with this kind of distribution, then I know I can even do a 2 times leverage on it because I know, well, worst case, I'll be down 40% over 20 days, which I know I can handle because we'll make it back. However, most people don't understand these numbers. They either panic and exit there and then they miss the gains, or they over leverage, get a margin call. They're down 40% in 20 days. When you're down 40% in 20 days, you are going to panic because you're human. This is how CFD firms and spread betting firms make money because they know the psychology of this and the psychology of that. Right? It's very simple. If I'm reincarnated, I'm coming back as a spread betting broker because I've seen enough of them become billionaires as a result because humans are human and humans don't understand this and they don't understand it becomes this. The number of companies in which it looks like this, i.e. after 20 days, this is relatively small, I can count on the fingers of 2 hands. There's about 10 companies on the planet. I wish there were more. Well, if you go out and make them, good luck to you. Most companies aren't like this. This is why people like Warren Buffett and I would have relatively few companies in our portfolios, because very few which have under 20% after 20 days. They're the ones you can leverage. They're the ones you can hold for a long period of time because you know the odds are in your favor. It's that simple. This is Amazon's histogram. Okay, so I know I'll be getting in at some point again, because all these other things look great. You might as well, why are you waiting? Why don't you get in now? Well, because I might be able to pick it up instead of at 195. I might pick it up at 100. Why wouldn't I want it then? I don't have to. I could pick it up now and keep buying it on the way down if I wanted, but I'm looking for a bargain. Again, put it in Buffett's terms. I treat it as if I'm buying a business. If I can buy a business, I'm sitting across the table from these guys. They're offering me 195 to buy their business. They're saying you can pick us up for 195. I'm saying, listen, mate, I'm going to sit back. I think next week, next month, I'll be able to pick you up a bit cheaper. Now, if I'm wrong, I might have to end up having to pay a bit more. But I still know I can pick them up anyway. So I'm in no rush. The cards are on my side. And that's the mindset. The cards are on my side. Hi, Carwin. Hello as well. Okay. So I wanted to give a bit of that in the context of what's going on in the world and the way of looking at things. Now, I want to also show you this. Some Russell 1000 stocks with the largest increase in hedge fund owners. Okay. Now, I'm not in any of these, just so you know. I'm not in any of these, just so you know. Most of these companies will just be too volatile. If you take Tesla, right? Tesla is so volatile that it's not going to look like this. I actually haven't pulled up the Tesla version of this. It's going to be like minus 60% after 20 days. It's going to be off the scales. And that's a problem. Now, of these, the ones that I like for the longer term, for very long term, like say 5 years, I'd be fine with that for 5 years. Over any given year, it might be down quite a bit. ServiceNow over 5 years, United Health over 5 years. But right now, over just 1 year, and the others I've not looked at in enough detail. The problem with most people is they want their returns in a month. They want to trade. Okay, they have a trading mindset, and that's fine, but trading is something different. Okay, it's something different. By the way, I mentioned this in last week's one. It's not just applying to Rolls-Royce, because I get emails a lot about Rolls-Royce. Look, if you don't know what to do and you don't know what the future holds, which none of us do, and a proof of that is what's happening with Donald Trump at the moment. If ever you needed proof that nobody knows what the future holds, you've got it now. Yet private investors will try and look for the next person and the next person and the next person who's going to tell them. Nobody knows, and you're more likely to believe me nobody knows because of what Trump's doing. Because you can say, yeah, actually, I think you're right, Alpesh. Nobody bloody knows. You're absolutely correct. Not people with master's degrees in politics and economics, all very nice, but useless for knowing what it holds. So if you don't know what the future holds and you've got some gains in whatever it is, whether it's NVIDIA or Rolls-Royce or anything else, you can apply the formula. If it drops X, I will sell Y. Okay? And X1, X2, X3. And X can be 10%, 15, 20, 25, and you'll sell Y. Now, only in hindsight will you know what Y should be for each of those numbers. But your risk appetite will tell you in advance what it should be. When times are calm, it'll tell you what it should be. So don't try and pick the top and the bottoms, because the most successful hedge fund managers in the world can't do that. What you're trying to do is find why for your risk appetite and be satisfied that you'll have mitigated your regret. Okay? Otherwise, you'll make those numbers, you'll change them based on your risk appetite. And that's probably the far better way of doing it than some crazy notion that I've got to try and pick the bottom and the top. Picking tops and bottoms is great for journalists and financial broadcasters to lure private investors in. But actually, you can be a lot more sensible, and then you don't have to be so emotional either with your investing. If you're emotional with your investing, investing's not for you. It means you've either invested too much or you're gambling. I didn't say that. Warren Buffett said that. Okay. Now, let me tell you where we are at the moment. This is the S&P. Okay. We are still at 0.4, which is what I call a daddy bear. We're at 0.4, right? Now, for those of you who are my clients on the Great Investments Program, I'm not disclosing any great secrets. Okay. So don't worry. My clients will know exactly when I'm getting in, and they'll know first, and they'll know exclusively. So just so you know, we're at 0.4. We're not at 5. We're certainly not at 6 and we're not at 7, so I'm happy to wait it out. I am not trying to pick bottoms. Now, when this happened last time in 2022, I did not know 2022 was going to be a down year. The computer has opinions, we follow the computer. We don't have opinions, the computer has opinions. The world's most successful hedge fund manager said that, Jim Simons, and he's right. Okay, the computer has opinions, we follow the computer. The computer isn't always right, but it has opinions, we follow it. We don't have our own opinions, okay, because humans are rubbish at opinions. Now, when that became a 3 and then a 4 in 2022, I did not know how far the market was going to fall. I didn't even know it was going to be a down year. Well, how the hell did you know to get out? Well, because it was a 3. And we know when a 3 happens, we're better off being out than in. That's all. Look at how little I've actually said. I didn't know it was going to fall. I didn't know it was going to be a down year. I didn't know how much it was going to fall. All I knew is I'm better off being out when it's a 3 than a 4. That's how money's made, not by over-predicting. If you know anything about probabilities, you know that probabilities are multiplicative. In other words, they diminish as more things you need to predict being right. Okay? So the less you predict, the better. Similarly, we didn't know in 2003 it was going to be an up market by how much. All we knew is when it's a 6, we're better off getting in. Did we get in at the bottom? No. We'd be into witchcraft if we could pick bottoms and tops and time machines. We got in the same place so many hedge funds got in, which is late. We're lagging. When retail clients are the only people who are idiotic enough to say, well, isn't that lagging? Geez, what do you want? Time machine? Perfection? We're doing fine. Lagging. Thanks, mate. Lagging gives you greater probability, better reward to risk, because the probabilities are better in your favor. Not some guarantees, and most retail investors can't tell the difference between a guarantee and a probability. They just can't think straight. Okay, and that's one of the biggest problems. I'll tell you one of the new things we've done. So we said, well, let's take our approach through a really difficult time. Thanks, Carwin. Thank you. Let's take a really difficult approach. Let's take our filtered list. Those of you who know what we do know that we have an approved list of stocks, which is out of 10,000 we filter into 200 based on the valuation of companies, undervalued companies, growth companies. We want companies which overlap on being undervalued and growing and producing dividend yields, because obviously you would, common sense, but more importantly, academic literature from Nobel Prize winning economists and investment banks shows you undervalued companies do better than overvalued ones. Growth companies do better than ones which aren't growing. So we just overlap those and say, well, what if they're undervalued and growing and producing dividends and have high Sortinos, high average returns, low risk or volatility of missing it? We're just cheating. We just try and tick those boxes. Even if we tick all those boxes, we can't guarantee the future because Warren Buffett can do because Donald Trump can do a tweet. Anyway, so we took this and we said, well, let's take this for a spin. Let's put it through the hardest of hardest times, shall we? Let's take it through a period where, okay, what we do is, and I'm going to try and show this in a moment. What we do, let me just show you. I'm going to show you on screen in just a second. Let me just make sure, first of all, we want to pull it up. No, okay, that's fine. Don't disclose anything which is client sensitive. Okay, here we go. Right, so I'm going to share this on screen. What we did, relatively straightforward, not rocket science, is we said, I'm just going to share my screen with you. We said, okay, we want through that approved list, none of these stocks meet my criteria. So if there's any clients on here, don't have a heart attack. None of them meet my criteria. We said out of 10,000, which ones are undervalued, growing with dividend yields, which are giving us cash return on capital invested, which ones are up over the, showing a bit of momentum, Sortino, Alpha. Anyway, we wanted all those to be green, and then we filtered it along there. So we said, well, wait a minute, Alpesh, if you're so good, why don't you take this for a little spin in the worst possible weather, the worst possible environment? Let's take our February 2025 picks, right, where the market peaked this year before Trump tanked it. All-time highs in the market. What were our selections? Let's do a bit better than that. Let's take all the filtered ones from the filtered list, which had the highest volatility, i.e. the highest risk. Okay? Given that they are more undervalued than they've historically been based on our metrics, growing better than they've historically tended to do, better dividend deals than they've historically had, and they've got a good track record of delivering good results. So we can assume they're solid, good, nice companies which will in the future do well. We then said, so what kind of returns could we expect? So we broke it down because when we analyzed it, we knew, having gone through the 2022 slump as well, that we're roughly right about 60% of the time, i.e. 60% of the time, 60 months, 60% of the months were positive, is what I mean. 60% of the months were positive. And we knew it generates 31% per annum returns, okay? 31% per annum returns. But like I told you, we picked the riskiest companies, i.e. the ones with the highest volatility. Risk means volatility, okay? Volatility, standard deviation, risk all mean the same thing for our intents and purposes. So we said, well, what does this look like when you take what you consider as a good plane through turbulence, like Donald Trump? What might that look like? So we broke down every single one of those companies and we said, well, over the last 5 years, some of them only generated 3% per annum, 6%. This is the reality of it. And this, in February, they look better than they've ever done historically. But even historically, sometimes so many of the companies have been laggards. Okay, some of them, we've got one here. I can tell you what that one is, by the way. We had it in February, is NVIDIA. Okay, this one I'll tell you, the 64% one, the best performer happened to be that one. But there were others with 55%. So there were some which have generated over the last 5 years minus 25% per annum. Well, hang on, if you've got a system and a process where you're looking at their valuations, their revenue growth, their dividends, how come some get 64% per annum and some get minus 25? That's the X factor in the markets. And it's why you don't pick one stock. If we knew there were certain factors which only led to 64% returns, we'd pick one bloody stock and tell you, here's one stock, go buy it, let's all go sit in the Bahamas. That's why you have more than one stock. That's why Warren Buffett has more than one stock with all his experience. Why do you think he doesn't have just one company? All right. So we ended up having more because we didn't want to end up with the minus 1.49 over the last 5 years, or the minus 20, minus 12, minus 1, minus 10. Okay. And I told you these were the most volatile. What does that actually mean? Well, let's look at what 30% per annum returns means. It means in their worst year, okay, in their worst year, some of these companies drop 37%, 31, 36. Remember, this is a portfolio which generates 31% per annum. And this is what was involved in it. So if you want to see how the sausage is made, but I've purposely picked the riskiest, which currently look the best compared to how they've looked over the last 5 years anyways. So we're happy if we had to hold it, but at the moment, because we're in a daddy bear, I don't hold any of these. Minus 40, minus 36. And this is the bit people don't get. This is why Warren Buffett said, if you can't withstand a stock you own dropping 50%, you have no business being in the markets, because look, that's one which has dropped 50%. Okay. Yet this is a portfolio which has generated 30% per annum. And most people will panic if they get any of these things happening. And by the way, these worst years, guess what? They always happen at the same time. So much for diversification. Okay. And before you think you're a genius where if you touch it, this won't happen to you, then you're gambling. This will happen to you. Again, that's what 31% per annum works out at. It's not guaranteed 31% per annum because I'm going to show you in a second. Look at the drawdowns though. That's what the worst year looked like. The drawdowns are even worse. Drawdown means from peak to trough. 83% down. Look at the drawdown on NVIDIA, 62% down. Assume that's when you bought it, you would lose 62% of your pension. Yet that's what 30% per annum looks like. And that's the bit people don't get. So does that mean you should just, buy the dip and just buy any companies and hold for a long time? No, because if the companies are rubbish, you can't do that anyway. We purposely had picked companies which had gone through high value, growth, income, cash flow, Sortino, alpha. And this is based on our February portfolio. Okay, these now look better than they've ever done. This is how they've historically performed. We expect them to perform better, but we assume they'll still perform like this over the next 5 years. We'll assume not that they'll give us 30% per annum going forward for the next 5 years as it has done for the past 5. We'll assume we'll get these max drawdowns, though. I'll guarantee you'll get all of this happening. So do you want 30% per annum? And you'll say, well, I thought I did, but I certainly don't want to be going through that. In the same way, my trainer says, do you want a six-pack? And I go, I want a six-pack, but I don't want to bloody go through all of that pain that it involves. That's the bit people don't understand. Now, luckily, you can have lower volatility stocks. By the way, I want to show you something else. We created this for one of our students. This is a different portfolio for him. It's not the one I've just shown you. Okay. And we show our students what are the underwater periods. That means how long would you be underwater in your return? How long does it take to recover? And we assume you didn't even get out using our Daddy Bear rule. You just stayed in. So worst case, you just stayed in. And your drawdowns, that's 28% of your pension gone. That's 18. Guess what the return on his portfolio is historically? 37% per annum. But there's your drawdowns. Guess what most people are going to do? They're underwater for 4 months. They're going to start crying. 5 months are going to start crying. Yeah, I know what you think. No, I wouldn't. I'll push. Yeah, because you think the 37% is guaranteed. No, what's guaranteed is the downside in life. The upside's never guaranteed. Okay? And we can't guarantee the future. But that's the bit people don't understand between volatility and returns. So you might ask me, what are you saying? What are you saying? Should we just buy and hold forever? No, it still has to be good companies. And you can reduce some of this downside by either reducing the volatility of the individual securities that you select if they're good companies and filtered, increasing your time frame so it's not just holding for a month or 3 months. Obviously, 5 years becomes a bit easier. 12 months, a bit riskier. Okay, but some of my students want the risk of 12 months. Others say, no, I'll elongate the time frame. Thanks, mate. All right. And the third thing is to look at how it did previously and assume it's going to do it again. And as long as it stays in the historic bounds, then you know not to panic. And like I said, the other way to reduce the risk is you have the overall overarching Daddy Bear rule, similar to what Warren Buffett has, where he gets out of a little bit of his Apple position, but he knows he's going to buy back cheaper because he said he is. Okay, similar ruling to that. Okay. I know there'll be some questions later, but I will do that. Hello, Edward. How are you? Now, where are we on valuations? I'm not getting into any of these at the moment. Where are we? But I know these are the ones from here where I'm going to be able to get, as I did in 2023 and 2024, my 100% returns. I don't know which companies yet. Well, I've got a pretty good idea. I've mentioned some of them earlier, but not yet. If you do it at the moment, what's going to definitely happen is you're going to get to panic stations because you've got your risk appetite wrong. And the headlines and the news is going to scare the bejesus out of you. Microsoft, you're paying $25 for $1 of future expected profits. NVIDIA, you're only paying $19 for your future dollar of expected profits. So look, if you want to go and buy it today, feel free. I'm being a bit tight, and I'm saying I think I can pick it up even cheaper because the market's going to over the downside, and I'm going to look at average prices on the way I showed you earlier. Simple. Amazon, Tesla's still expensive on that. These banks are dirt cheap, and there's going to come a time when I'll be able to pick those up at really good bargains. I still don't want to do it yet. I know. I'm the part of India. I was born in Leeds, which is not in India, by the way. It's in Yorkshire. But the part of India that I hail from, it's like the Scotland, as the cliche goes, of the United Kingdom. In other words, we're known for being a bit tight with our money. Let's put it that way, or some of us are. So I want to be tight with my money. I'm not going to get into, well, Goldman Sachs, my son still holds for 5 years. Well, he's 7. I've told him he holds it for 5 years. I sold mine because I was looking at the Daddy Bear rule, but for him, I thought I don't want to be bothering to change his and my wife's portfolio all the time. So he's still got Goldman's for 5 years. Most people will either get bored or panic. Why do people get out of good companies prematurely? Because first, they don't know what a good company is. Secondly, they get bored, or thirdly, they panic. Well, it's very simple. Okay, it's very simple. Now, where are we on earnings? These are the earnings announcements that are about to come out. Well, Wednesday happened. Thursday, that's happened. Well, market's closed. Yes, closing just now. So after market close, you're about to get Netflix any second now. I'll tell you what's going to happen with every single one of these. Their historic numbers, no matter how good they look, is not going to cause them, generally, some of them might, to skyrocket, because people are going to say, well, the future looks a bit uncertain, right? One or two might skyrocket. I think, I think Hertz or somebody had something good come out. Anyway, don't trade that. If you want to gamble, go ahead and gamble. The shorter your time frame, the closer you are to gambling and going to Ladbrokes. If you want to bet on what their earnings are going to be 1 minute before they're announced, that's gambling. If you're looking at a 5-year time frame or even a 12-month time frame, and you know the company's solid based on some of the factors that I mentioned, then you're not gambling on one set of earnings and you don't care about one set of earnings. And that's the mindset to have. So this is what's going to happen on Tuesday or something on Wednesday. By the way, there should be nothing on Friday because they've got a holiday in the US on Friday. Good Friday tomorrow. Okay, so that's where we are. Now, if I'm very risk averse, and again, I'm not disclosing any secrets by revealing any of this because all of these are overbought. They're the lowest volatility exchange traded funds, which beat the S&P last year. They, over 5 years, doubled your money. And in 2020, they didn't fall as far as the market. But you know what's going to happen? I guarantee you, somebody thinks that they're brave enough to hold it for 5 years. And then 5 minutes later, they get bored or they panic. Let me show you what I mean by panic and why these exchange traded funds at the moment are not what I'd want to buy. Look at that. From 3,600 roughly to 3,000. So you had short of a 20% drop. And you didn't even know it was a daddy bear. 20% of your money, your pension got lost like this. And that's the world ETF. So the problem is most people don't understand that 4% volatility can mean 20% drop in your pension in 1 month. So they don't understand. So they go, oh, I've got a low risk. I saw on TikTok somebody said, do the world ETF. Absolutely idiotic because they don't understand that. So they might either put too much money in or they just don't have the perspective that they bought into something which is overbought. How did they know it was overbought? Well, bloody hell, look at what it did before. So there's always that danger. And you'd only buy an overbought security if you're risk loving. If you're not risk loving, you won't buy it. Hi, Sandeep. Hi, Dylan. As well, Eli Lilly up 15% today. I think we're going to look at that a bit later on. Wisdom Tree dividend growth. Okay. Now we know we're going to get this later in life. Boredom and panic means you're not going to get this. You're either going to get bored or you're going to panic. Let me show you what's happened with that. Definitely a daddy bear. It was overbought to begin with. So only the risk loving would ever have got in when it's that overbought. The benefit of exchange traded funds with low volatility is the drawdowns. DDD, write that down. DDD, drawdown danger equals depth times duration. Drawdown danger equals depth times duration. So the drawdown danger is how deep can the drawdown be, i.e. the fall from peak to trough, and what's the duration, the time frame to recovery. Okay, that's what you want to know. 2 things you want to know. That's your risk. The 2 things you ever want to know is drawdown depth and duration. You work out what your personal appetite is. Then that's simple. Life's simple. You just stick to that. If you stick outside it, okay, so if the drawdown depth and duration is this, but your appetite is this, then as soon as it goes outside that, you're going to panic and you're going to sell. Simple as that. If the duration gets too long, you're going to get bored and sell. If the depth grows too long, you're going to panic. This is boredom. This is panic. That's why it's important to know what your personal risk appetite is and what a security can do so you overlap the two. And one thing that I always want to do with these things is if this is falling, I don't want to be in. Basically, if it's falling, I don't want to be in. If it's overbought, I only want to be in if I'm risk loving. And I'm not always risk loving. I can be more risk loving when the whole market's rising. But I want to be out pretty bloody quickly otherwise. So whilst that'll be something I might buy later, but certainly not when that's falling. Very simple rules. If it's falling, I don't want to be in. Very simple. And the same thing happens with USA Multi-Factor. Yeah, I know they keep giving you money. Now, one of you is going to think, oh, Alpesh, you've just given us the crown jewels. We'll just buy that. I won't buy it now. You could be waiting 2 years and have 0% returns. Alpesh, what's going to happen in the future? I don't know. I don't know. John Maynard Keynes, famous economist, once said, if experts said more often they don't know, the world would be a better place. I once said it on CNBC when I was asked about price of gold. I said, I don't know. They were shocked because everybody else likes to bullshit. I don't. If I don't know, I'll tell you, I don't know. And everything I've told you is all about probabilities, not certainties. I might sound clever if I said it in certainties, but I'd be lying to you if I said it in certainties. I don't know what's going to happen. I didn't think this was going to be a down year. And if you've heard me before, you've heard me say I didn't know 2022 was going to be a down year. I follow what the computer says, and that's a hell of a lot better than what I think. Okay? Look at this, S&P minimum volatility. I don't want 2 years of not making any money, i.e. I don't want to be in when that's falling and that's falling. And we knew it was going to fall at some point because it was already overbought. What's overbought? Well, if you look at that window, it's anything in the top bloody third, I guess. Now, you might say, well, it might have bottomed and gone in. Well, yeah, but I'm not trying to bottom fish and pick the bottoms there Might have done, but I'd rather wait for it to make a move closer to this when it starts rising. Thank you very much. Okay, like there or like here. I'd rather be there or here. Not get rich quick, as you can see. Look at those periods. That's not get rich quick. That's all get rich slowly. Again, as Warren Buffett would say. So when we look at individual securities, we look at funds as well. We look at individual securities for our clients, and we want all of these columns to be green. Sorry, these first 5 columns to be green. We still can't guarantee the future because we can't guarantee what Donald Trump's going to do next. And if that comes as news to people, I'm really worried for you. Anybody who tells you this is what's going to happen, they're lying. I've said it before, and I'm saying again. I didn't know 2022 was going to be a down year. I didn't know COVID was going to happen. I didn't even know the financial crisis was going to happen. I'll give you proof of how I didn't know the financial crisis was going to happen. Other than that's written in my books that I didn't know. Prime brokers to my hedge fund were Bear Stearns. Bear Stearns went under. Do you think if I knew the financial crisis was going to happen and drag in Bear Stearns, I would have had them as our bloody prime brokers? No, of course not. What a pain in the ass that was. Okay. But when you tell people that, of how little you know, they don't want to believe you. You must know more. You're not telling us something. You're just being modest. I'm not. In my business, it makes no sense either having an ego or being modest, because you're only kidding yourself. It's your money. S&P 500, that's where we are at the moment. Yeah, there's a bunch of companies which are doing well. There's a bunch of companies which are underwater. Don't read too much into bubbles. Past week, don't read too much into a week. If you're here to invest, then you really don't care what happens in a week. As Warren Buffett said, in the short term, the market is a voting machine. Yeah, I know Microsoft is up. Could be the bottom of the market, by the way, but I'll wait until we get short and medium term prices rising. Amazon, Tesla, yeah, I know they look great, but if I was trading, I might be interested in those right now, but I'm not trading. We're talking about investing here, and I won't mix trading with investing in the same webinar or the same conversation for that matter. Broadcom. Oh, but does that mean that's the bottom of the market? By the way, here's something interesting. So where's the diversification then? Surely diversification means some things go up, some go down. How come everything's gone up then? Or look at this. That's your past year. Tesla, you're up 50% if you hold Tesla. Walmart, expensive at the moment. Costco, expensive. They are ones which we will go back to at some point. You know, there are certain companies we can keep dipping into to make us rich. We're not in those at the moment, and we haven't been for over a year because they're so bloody expensive. But there'll come a time in the future when they deflate and fall a bit more. And I can see why Walmart might, but we'll just wait. We're not gambling. We're not speculating on our opinions, though people think that's what fund managers do. Nvidia, 27% over the past year. JP Morgan. So my son still has JP Morgan and Goldman Sachs, and I'll tell you some other stuff he has. And whilst they're both up for him over the past year, he's going to hold it for 5 years. So is my wife. Okay, because I wanted to show some of my clients that you can hold for 5 years. You don't have to do 12 months all the time if you want a quieter, easier life. Okay, but it means that you'll end up holding through daddy bears. You might say, well, why are you making your son go through that? Well, he's 7, so it's fine. And I can't be bothered with the bureaucracy, but I also want to show an alternative way to people and show them over the long term you're still fine. The sort of more the Warren Buffett way. Year-to-date performance. Okay, Amazon's down 18, Apple's down 19. You can see where the money's going to be made. If something drops 20%, then for it to go back to break even, i.e. back to where it was, that's a 25% return. So I know I'm going to get 25% at least out of Apple. In fact, I know I'm going to get more because I can do 2 times leverage on it when the right time is to get in. And that means I'll get 50% return on my pension on Apple. And there's Microsoft and Nvidia. And, you know, some of these are going to give us some good returns in due course. I'm not in them at the moment. So those who are clients, I'll tell you when I am. It's not at the moment. Okay. As well. Dominic, the answer is yes. ETF 1 month performance. There's nothing I want to tell you on this other than all the commodity ETFs are overbought. China their ETFs look good for a while this year at some point, and India looked worse. But now suddenly it's turned around. I'll have to do a separate webinar on that. I don't want to go into those at the moment because I haven't got the data on them more than what I'm showing you on screen. So in due course, I will do that. Markets 1 year. This is where we are. Now, here's the interesting thing. If you said, hey, Alpesh, how did you do last year? Thank God the Romans, or whoever the hell it was, the Gregorians, if they existed, made their calendars from January to December, because January to December, the index was up 25%. We looked great. If they made their calendar from April to April and we hadn't got out at all at the Daddy Bear about a month ago, then we would have looked rubbish because it was only up. Look at that. We would have looked rubbish. Look at the randomness of time frames. 12 months January to December, we look great. 12 months April to April, we'd look mediocre and rubbish if we hadn't. And it's one of the reasons we get out at the Daddy Bear, because we can see it. Why wouldn't we? Okay, so this is where the markets look over the past. Yeah, but like Warren Buffett, I get very excited when markets are falling because it means I'm picking up some bargains, because I know the markets will overreact in good companies. Out of 10,000, there's only 200 companies I'd narrow it down to. And out of that, it's probably only about 20 I keep going back into, in, out. Well, I could just hold for longer, but I can't help myself if there's a Daddy Bear. I just don't want to see the prices keep falling and me do nothing. US market, I don't really care about sectors. Again, going back to the Warren Buffett thing, it just turns out that I quite like looking at individual companies, not sectors, or forecast growth for those sectors, just there for interest for you. You can see some of the top gainers of the past 7 days. Well, look at that. Our go-to team, none of them are playing for us in our portfolio at the moment, okay? Because, hey, Daddy Bear, so we don't need to. This is the UK. I'll do a separate one on these. That one's come up a couple of times. I don't own it. Probably worth looking at. Bit expensive, but probably worth looking at because it's come up in several things on my various journeys. Let's put it that way. So where are we in the S&P? What do I mean by Daddy Bear? This pattern here, which happened here. When that happens, I get out. Now, you can argue with me. You can fight me. You can hate me for saying it. But I try not to be in the markets. And even when they rise a bit and everyone gets all euphoric, these are called bear traps, what I'm circling. So that's a Daddy Bear. What's a Mama Bear? A Mama Bear is this, where the market, where the prices are falling, but they don't go below their own moving average. And a Baby Bear is when prices are falling, but the market, the average price is still rising. The MACD is still rising. So there's a Baby Bear. MACD rising, prices falling. That was a Baby Bear, and you can ignore babies. Mamas will scare you because you don't know if it's going to become a daddy or not, and that one didn't. Most mamas don't become daddies, and daddies happen once every 3 years. It used to be every 5 years, but they seem to be happening every 3 years. 1, 2, oh God, 1, 2. Well, you seem to have a 2-year break between Daddy Bears at the moment. Geez. So the next one's due in 2027 by the looks of this, because we had one 2020, 2022, 2025. Well, that's 3 years, I guess. So 2027, expect another one. And in between then, I guess this will sort of flatten out, rise again, and then give us another one, I guess. Anyway, it works out a hell of a lot better for me if I'm not in the market when that happens, and I buy back cheaper later. The NASDAQ similarly looks like it's going to crack below, and when it did it before, which is, I used to show this on Bloomberg TV. Did anybody watch me on Bloomberg TV 25 years ago when I used to show all of this to people? Anyway, or in my books. If you've bought any of my books, let me know. I'll give you a free copy of my book to everybody who's on the webinar later as well. Plus, the NASDAQ looks like it might do this again. Okay, and along the way, people are going to get euphoric, and journalists are going to go, "Oh, that's it, we got the best of it," and then, "Oh, we got the best of it." Oh. Okay, that happens. I will never get the bottom of a market. If I ever do, I've either been insider trading or I've taken up witchcraft. Or Doctor Who's given me his. He doesn't have a time machine, does he? H.G. Wells has given me his time machine. FTSE 100. Now, with this, it's a coin toss, absolute coin toss, whether it's going to go lower or it's going to do what often happens, bounce off its moving average. I do not know. I simply don't know. Okay, I can give you a macroeconomic case why it could do either. I don't know. I do not know which way that's going to go. Okay, I can give you a guess on either direction. Thanks, Raphael. It happens in a blink of an eye, my friend. 2 times average. So one of my students said to me, "So what would you get into first?" Well, I'd probably toe dip in when that pattern happens into this. Will be one of the first things I expect. But it's only not at the moment. Okay. When that happens, I don't know how long it's going to be. I do not know. It could be 9 months from now. It could be 1 month. We don't know if it's V-shaped or not, but I'll look at average prices to get in. And it'll do what it's done for the last 25 odd years. It'll make me money most of the time because it's probabilistic. If it made it every single time, you should be worried. I'd be worried. VanEck Semiconductor ETF, I'm not in. With ETFs, we use the same rule, okay? Because they're a basket of stocks. There'll come a time when we get back in, and it'll take us from 99 to 200. We will get double our money on it. Now, you might say, you're an idiot, Alpesh. Why wouldn't you just put all your money in that, borrow a ton, and just put it in that? I think my wife would shoot me. I don't think I'd be able to think straight if I did it that way. So we're out of it. Just clients, I'm not giving the public, this is a public webinar. I'm not giving the public any confidential information. Clients know this well ahead of time when we got out, when I told them on the private webinar, on the private Telegram channel. So it's nothing confidential that I'm out for the same reasons, but I also know where I'm going to make the money. I never was in Occidental. I'm showing this because Warren Buffett is. And I said a while back, I said, oh, that might be the bottom, but this is still falling, so I'll wait. Well, thank God I did wait because it wasn't the bottom. But so there's no action to be taken. And this is the other thing. People say, when do you think? Who gives a flying whatever? When? It's not today. It's not today, the day to get in. So what do you care when it is? NVIDIA, when do you think it'll be? What do you care? You're busy. It's not today. Don't want to get in today. And it's getting cheaper. But I know we'll be getting ready to pull that trigger whenever that time happens. I don't know when it is. I do not know. Look at this. In 2022, it was a whole bloody year. It was a year. Did I know it was going to be a year? No. Did I know 2022 was going to be a down year? No. I didn't even think 22 was going to be down, but the computer has its been, so we follow the computer. But we can only do that with companies with narrow statistical ranges, which have good value, growth, income, cash flow, Sortino. Otherwise, by the way, this doesn't work with companies which don't meet the criteria that I showed you earlier. You know what I showed you earlier? This only works with companies which have that narrow statistical range and value, growth, income. They're all filtered. That filter button there, okay, which tick all these boxes, then it's a better one to work for. It doesn't work with all companies. So in case you're thinking of using it with every random company, good luck to you, right? So we use it on NVIDIA, we use it on Apple, Amazon. We can't use it randomly for things, okay? Broadcom, I'm not in, just so you know. Tesla, too volatile anyway. Whenever we've tried to be in, we've got it right once and wrong once, which just shows you what Tesla is. And I think I might even ban it in future from being one which could be considered. Just because, first of all, on the fundamentals, the numbers aren't there. I'm sure in future at some point it'll be up tenfold. It's just that the journey's too volatile. Do you know what I mean? A bit like the founder. I just don't want the volatility. In other words, by the time you know to get out, you've lost about 50% of your money. It's like poker. If you've got to lose so much before you find out, why the hell do you want to do it? Novo Nordisk, one of my favorites, but not yet. Not yet. There'll be a time when it doubles our money. And on a 2 times leverage, we'll quadruple our money. Not yet. All these guys, premature. They're young analysts. They're bound to be premature. Hey, Raphael. So that's the direction of travel, but certainly not yet. And you get in early, you're going to be without a plan. That's a problem. Okay. If it didn't get out in time from market, would you be wise to sell in bear trap rise? Well, the problem with that, Martin, is you might be getting out at an even worse price, and you don't know when it's going to happen. So it's a bit like sort of asking me, look, Arpes, you fix cars, can you fix my bicycle? Oh, okay. Yeah, you could wait for a bear trap rise. Or you could just say, I'll elongate my time frame, which if it's a good quality company, I'll just hold it for 5 years. I didn't get out in time. I'll just hold for 5 years. I'll elongate my time frame. Again, I'm not in this, but there'll come a time when I will be. Not right now. So what do I mean by these returns? Well, what does 26% per annum look like, which is just these companies alone? Well, it looks like doubling your money in 3 years. It means being right 66% of the months, but the past doesn't guarantee the future. It means there'll be prolonged periods when, for instance, in 2025, every single one of your holdings is down and you've lost 11% of your money. All right. And if you don't use the daddy bear rule, You could be down 28%, 64%, 39, 50, 26, but that's what 26% per annum looks like, being right 65% of the months and doubling your money in 3 years. It actually looks like losing 41% of your pension, which people find difficult to understand, right? That's why we have the daddy bear rule on the quality 5 to avoid that scenario. That's all we're trying to avoid. We're trying to basically cut this off here, which we have done so far, and avoid this going down. It might rebound and we buy all of these stocks back at a higher price than we sold them. One of the most important things to show clients is if you didn't use the daddy bear rule, which is 2022, you've lost 41%. This is 30% returns, or what is 27% returns. You're underwater for 1 year, 7 months there, or 8 months, or 3 or 7. If you've got a client who's underwater for 7 months, they might panic if you didn't show them how to breathe because they're underwater. So they might panic. Underwater means where they've not gone back to their previous high water mark. Okay, so they're negative returns, and the drawdown is just 10%, you might say, in 7 months. They can take it. So we ask them, what on your risk appetite is the longest duration of drawdown you want, and time frame you can handle it, your drawdown depth and duration, and then we try and fit things accordingly. Or we show them historically, well, this is what 27% looks like, so you better, if they say to us, we want 27% per annum, but I only want drawdowns of 1 month and 1%, we say you're an idiot. Well, we don't say that, but so what we do is match it up to the returns, and normally they want this to be massively high and this unrealistic with that. You can't have both. So some of them then say, well, actually, I'm happy to take say a 20% return historically, not guaranteed for the future, but I'll happily take being underwater for 7 months and 10 months drawdown, 20% drawdown, etc. Because there's you've got to match it with what's out there. You can't say to me, can you make me silk slippers, Alpesh, which won't fray? I can't create the impossible. Anyway, this is Buffett, Gates, Goldman Sachs' portfolios. He's got 70 billion, or a quarter of everything that he invests in the stock market is in Apple. For all those people looking at social media going, oh my God, he was saying, he got out of anything. No, there were some reductions, but he owns 26% of Apple still. And I'm sure when the next set of figures come out, people are going to go, oh shit, he's been buying some. I bet he's bought some more at a cheaper price, certainly of the ones he sold. Anyway, these are the things he happens to hold. Okay, it doesn't mean you go out and buy it, because he bought Coca-Cola in 1965, I think, or something. Anyway, where am I at the moment? So I tell my clients each month, where am I? Where's my risk appetite? And when the monthly average prices in the S&P are rising, I'm here. When they're going sideways or overbought, I'm usually here. And when they're falling, I'm here. It's very simple. I'm a very simple person. I'm not as clever as people think. I like simple processes because processes prevent panic. Put another way, I think it's a motto from the SAS, piss poor planning produces piss poor performance. This was last year using this approach. Were we lucky? Yes. Let's assume we're always lucky. We were lucky. We just used the rules that I mentioned. Okay. We don't have to be smarter than the rest. We have to be more disciplined than the rest. That's all it is. It's all we have to be. Okay. We just have to be more disciplined. And for us, the discipline is very simple. We're not smarter than anybody else. I don't know what the future holds. Okay. There you go. We just need all those to be green. That doesn't guarantee the future. I just showed you the volatilities. Just means either our clients will hold for a longer period of time, or if they're holding for a shorter period of time, we'll reduce the volatilities of what they hold. So it suits their risk appetite. The worst thing they can do, and I showed you that portfolio, is they can have a 12-month portfolio with very high volatilities. And I showed you what the outcomes could be in that range, that they might end up getting in on a bad year and being down, even though the portfolio as a whole over 5 years produces 30% per annum returns. Okay. And it's a bit people can't quite understand. Another way to sort of mitigate their risk, if I've got a client who's near retirement, we had one today, he's pretty much at retirement, and he goes, but I don't want to hold any cash. So you're sort of trying to explain to him, you better bloody well hold cash, mate. This is from Goldman Sachs Wealth Management. You need to have about 50% in cash. Goes, oh, I don't want to do that. I want it all in stocks. And so there's this unrealistic expectation people have about how prices behave, because you say to them, oh, these are the returns over a long period of time. And they say, right, let's put all our money in. And I said, well, no, because you're at retirement and you want to withdraw money every year. So why wouldn't you just have 50% in cash? I'm very risk averse. Market risk. When I wrote my first book, Mind of a Trader, where I interviewed the world's leading hedge fund managers, and the Financial Times published that book, I was shocked at how many of those hedge fund managers said we're risk averse. I'm very risk averse myself, and I think it's the more professional approach. 40 stocks regularly or 20, not at the moment, because at the moment I want to remove market risk. The only way to remove market risk is by not being in the markets. Sorry, did I spell retirement wrong somewhere? Probably somebody spelt it wrong somewhere. Oh yeah, he spelled retirement wrong. Yeah. So this was regenerated, this is taken from Goldman Sachs, but it's regenerated by us to avoid any copyright problems. But yeah, my graphics guys put that wrong. These numbers are exactly as they've given them to their clients. It's not controversial, this. But thanks for pointing that out. Have a look at that if you want to have a free investing course, free book, or anything else. One of the other things we do, because we don't have a monopoly on knowledge, is we also look at any hedge funds which have been generating 40% per annum. This one's been generating 53% per annum for the last 3 years. And then we look at what they hold and if they meet any of our criteria. Now, if we can get just 15% per annum, then you double your money in 5 years. Just 15% per annum. I don't think it's worth taking a lot of risk to try and get to 20% per annum returns, because you're only reducing doubling your money from 5 years to 3.8. Okay, I don't think to get that extra, to remove that 1.2 years, to take a vast amount of risk. So that's not bad. By the way, that's the S&P return over in sterling terms, in sterling, not in US dollar terms, over the last 15 years. Is that so? Actually, we double it even without trying. 32% is the return over 2 years, 88.5% of the time. So we've got a tailwind. Again, as Warren Buffett says, we've got a tailwind. Our job is not to F it up by panicking or getting bored. By panicking and getting bored. Avoiding panic and boredom are the two best ways we can do it. And avoiding some of these will help us by simply having the Daddy Bear rule. So the Daddy Bear rule is to avoid that. And then we know the market has a wind to our back anyway. In fact, I wrote a piece. If you haven't followed me already on LinkedIn, I would recommend you do it. I wrote a piece which had on LinkedIn, it had some of those. So if you follow me on LinkedIn, you'll see it. It had some of those Warren Buffett quotes on there, and it's pretty good actually. Because it reinforces some of my pre-existing beliefs. And basically, I take the view that if he said it, it's as good as gospel. Okay. Let's reset that poll and let me ask you something else. Okay. Now, feel free to look at this. So I'm going to answer some questions. SIPs, ISAs, you've got Barclays, you've got Hargreaves Lansdown, you've got AJ Bell, you've got Interactive Brokers. There's so many choices. At this moment in time, please be aware of St. James's Place, Scottish Mortgage Investment Trust, Fundsmith, and the like. They cannot go into cash. They cannot remove market risk. They're not allowed. So the danger is this happens again. 2022, where 50% of your pension gets destroyed by your wealth manager because they can't go into cash because they don't earn fees and they can't charge you fees if they go into cash. Okay, so please, please, please. The reason we provide you with all of this data, well, to clients anyway, is one of the things people have mentioned there is transparency. And on a private Telegram channel, twice a week, actually about 5 times a day, I explain things to people so they've got communication constantly. I'm going to answer some questions on the markets generally. If you want to be part of the program, feel free. I take 10 people on at a time, and on the webinar, I give you a nice little discount. We only have a one-off fee. We don't charge subscriptions. I don't like monthly, weekly subscriptions because if we do that, then we have a conflict of interest with you because then we've got to lie to you and tell you not to be in cash when you should be in cash. Okay, so I don't like subscriptions. Like a newsletter, tacky newsletter, giving you subscriptions where you've got it's not safe. Okay, you can go there, but use that if you want to be part of the program. Okay, sorry, it's expensive. The price has gone up, and it's going to continue going up. Hi, Alpesh, what will you look at apart from the MACD to re-enter the market? Nothing, Stas, because I've just explained to you why not. Okay, I want to show you something else. If you want some more free content, just go to alpeshpatel.com/shares. You'll see here with the preview bits are quite useful, actually, because it shows you how pensions lose your money and how they keep on losing your money constantly and consistently. Ask me any questions. I'm going to answer your questions now in case there's anything that I've missed. I'm also going to give you a free copy of my book and a few other goodies right now as well. Okay. Here we go. You should be able to do that right now. You should be able to download a free copy of the book as well right now on there. And I'm going to look at the chat to see if there's any questions coming along of anything that I might have missed at all as well. We've done, exactly 1 hour. I've done rather well. I kept it to exactly 1 hour. Okay. So I wanted people to see that. Okay, need to sign off. Many thanks. No, absolutely. 1 hour. You're done. You're good. You're good. You're good. You're good. I'll let the designer know he spelled retirement wrong. So yeah, you've got a bunch of stuff there which you might want to look at as well. Oh, investor persona. That one's relatively new. We also show you how 2024 turned out 2023. Okay, so have a look at alpeshpatel.com/shares on that. My plan is eventually to float the whole company and make it a competitor to a St. James's Place type, where instead of charging people fees, we actually give them the data and the education so they can manage their own portfolios, so that they're not having to pay fund managers. Actually disintermediate the fund managers and the IFAs and the wealth managers, but educate people instead globally. And we've got clients from around the world at the moment. That's something you can float. I've spoken to the London Stock Exchange already, actually, about it. I don't know when, but it's an ambition I've had. My dad floated his, he had a dye manufacturing company on the Mumbai Stock Exchange. It's still there. So I've got to do at least as good as my dad. I won't ever do as good as my dad, but there we go. This is it. Now, questions. I'm going to check. Yes, enjoy the bank holiday, everyone. I will be doing that. I'm in London because my son doesn't like flying, which saves me a more fortune. Have a look at my campaign for $1million.com to teach 1 million people how to be better investors. There's Naga. She's got a book tour coming on. So have a look at that as well. There's a ton of free resources there, which I think you might well like, everyone. Okay. If there's no more questions, I will go. If anybody wants me to reserve a space, I'm more than... Raphael, thank you very much. I'm very fortunate. I'm very, very lucky. You might say God's good grace or good luck. It's those two things. It is not my own doing. Anything good that's happened to me, it has been there but for the grace of God, as they would say. And if you're not a believer in God, then luck, whichever you want to call it, but it's certainly not me. Rare earth, gold, silver, it's a no-brainer. Peter, I'm not an expert on it, so I couldn't tell you. I couldn't tell you. Might be, but it's not a strategy through which I trade or invest. I'll give you an example. When I angel invest, I invest in private companies, or I used to. I'm not doing it at the moment. I assume I'm always going to lose 100% of my money. I've got Dogecoin. I did it for fun. I posted it on Telegram. I said, listen, guys, I'm doing this for fun, okay? Oh, by the way, I'll go in reverse through the slides while I answer the questions. I said, I'll just do it. I'm just doing it for fun, guys. Okay, so just so you know, there are certain, it's not me. You might as well ask me about, you know, I don't know, Lamborghinis. I don't know. Ask me about Lime bikes. I know about how Lime bikes work. I'm an expert, but yeah. Got to ask the right person the right question. I'm not that person to ask about rare earths. Harper, it's not too late. What are your thoughts on gold and gold miners at present? Overbought. The ETFs are overbought. So there's a risk of a pullback. So notice I didn't say anything to do with macroeconomics, because I don't on that. That'd be a narrative and a story. I can feed you a good story if you wish, why it could go up, but I don't believe it. I'll look at the average prices, and I have done for the last 25 years on those two things. And my wife bought some gold coins in December. She's not an expert. She's done incredibly well. But I just couldn't, beyond what I've told you on gold, the overbought exchange traded funds, Therefore, it's a higher risk to buy them now, which is only telling you what you must already have intuitively known. I don't think. That's 26% per annum. Can you believe it? Okay. Is there a point at which it's better to stay in a daddy bear when you've already lost, say, 30%? Rod, it's a good question. Yeah, just elongate your time frame, as long as it's quality what you've got. So yeah, psychologically, you don't want to take that 30% loss. I appreciate that. And psychology is important. And you can say to yourself, you know what? I'm just going to have a longer time frame. 5 years, as Warren Buffett does. Warren Buffett is in a daddy bear. He's fully invested. So take solace from that. But if you don't elongate your time frame and you've got quality companies, if you haven't got quality companies, then it doesn't matter whether it's a daddy bear or not. You're screwed because you haven't got quality companies. You're gambling all along. Okay. So let's take, have I got Meta here? If I've got Meta, I could show you Meta as a good example of, no, I don't think I have, sorry. Meta is a good example. It dropped 77% in 2022, and then it rose and made it all back over 2 years. So you made 0% over 2 years, whereas we made 144% over 2 years, because in 2023, we got back in, didn't know it was going to go up that much, went up, great. Thoughts on video? Jazz, the same thoughts I gave you earlier. I'm out because it's the daddy bear, and I'll get back in when it's no longer a daddy bear, and we'll do 2 times leverage and make a killing. I said that earlier. It's as simple as that. If it falls below 100, 90, I don't know when we'll get in. I'm just trying to be cheap. I don't know. I might pick it up for $10. I don't know. But I'll wait until the average prices start rising before I get in. So that could be at $10, could be at 90, could be at 100, could be at 110, could be at 130. I honestly don't know. But that's the point at which I'll get in, because that's the time. It's always worked for me. I'm not speculating beyond the process. Process keeps you disciplined. It avoids emotion. It avoids effing things up. It avoids guesswork. Guesswork equals relying on luck, which equals emotion, which equals gambling, which is what most private investors do. Most private investors are absolute gamblers with their pensions, with their life savings, because they have zero process, and they run by the seat of their pants on emotions and make up ideas in their heads without testing them. Okay, so that's why. When you say out, are you all out, or do you use your DropX sell white? Glyn, the daddy bear, which only applies to those few stocks, which are the quality ones based on value, growth, income, and so on, and ETFs, I'm all out. But on, say, Rolls-Royce, which I don't own, just to be clear, it's just because I get asked about Rolls-Royce a lot for whatever reason. If it drops 10%, you decide if you're out 100% or 10%. If you're risk averse and Rolls-Royce drops 10%, you'll be out 100% because you're risk averse. If you're risk loving and it drops 10%, you'll be out 0%. So you just decide those numbers for each of those drops based on your risk appetite. What you're asking me to do is to base it on some future knowledge you think I've got. I haven't got that. And if you saw the number of bloody degrees I've got, you'd think, why haven't you got it, Alpesh? What a waste. Because nobody has. And if anybody claims they have, it's either inside information or luck. I'm telling you the truth. That's why I use this. I base it on my appetite, which makes me sleep easier at night. Here's a good rule for investing. If you can sleep easy at night, you're doing it right. I didn't say that either. Warren Buffett did. That man, everything he says, gold. Why not just track the MSCI World Index and spend more time with your wife and kids? Well, my wife and kids are asleep. If I spend more time with them right now, they're going to be really pissed off. And I try not to piss off my wife and kids, mate. There's a limit to how much people want to spend time with you. I mean, I could wake her up. So there's your MSCI World Index. Because if you like making no money for 2 years, then do it. Feel free. There you go. No money for 2 years. You can spend more time with your wife and kids and be poor. I suspect they prefer you to let them sleep and have more money in your pocket. Option 1, let your wife and kids sleep and have more money in your pocket. Option 2, be poor, wake them up and piss them off. It's up to you, Peter. Option A or option B. You sound like a man who wants to piss off your wife and kids and be poor. I'd rather not piss them off and have more money in my pocket. It's very simple. There's your tracker, 0% returns. Oh, there's your tracker, 20% loss in a month. Tell that to your wife. Do me a favor. Go wake her up and say, hey, I just tracked the MSCI World Index. We've lost 20% of our pension in a month. Sweetheart. She's going to be pissed off because you woke her up. She's going to be pissed off because you just lost 20% in a month. That's why. Option one every time. Glyn, I can't even remember what I said about option one. Mr. No, Jazz, that's fine. Okay, anybody else? Those are your earnings. Like I said, with most of these earnings, what's going to happen is either they're going to be very good or they're going to be very poor. State the obvious. If they're very good, I don't think the market's going to take much notice because the market's going to drag things down anyway. And if they're poor, then the market's really going to punish them anyway. And it's a good time to bury bad news for these companies and these chief executives because they can blame it on Trump and training. Yeah, let them sleep. Peter, look, everyone's saying, let your kids sleep. Stop waking them up and bothering them. So you got to let them sleep, mate. Don't wake them up. All right, I'm going to go. I will speak to you all later. For those who are on, thank you very much. I'm going to go and start my break, I guess. It's all a break. I love this. I'm like a kid in a toy shop. I don't know why I love all of this, but I love it. Just love it. What else am I going to do at 10 o'clock on a Thursday night? Watch Netflix? No. I'd rather be doing this and teaching people. They asked, again, I'll close with Warren Buffett. They asked Warren Buffett, what do you want me to be remembered as? A good investor or what? And he said, no, a teacher. And I thought, wow. He said, a good teacher. I'm going to put those videos up actually on my Telegram. I might put them up. I'll probably put it on. Actually, no, I'm going to put it up on my LinkedIn today. I'm going to put there's 7 Warren Buffett videos, which are only 3 minutes in total. 7, they're 30 seconds each roughly. They're amazing. I'm going to put it up on my LinkedIn tonight for all of you. So go to my LinkedIn later and you're going to find them there. Those who've joined the program, I'm going to send you an email shortly afterwards. Thank you all. And wishing you all a peaceful Easter. So thanks, everyone. I will say goodbye. I've got to make sure we're on the right page. Here we go. It's me waving down there. Thank you all very much.